Now, the first thing that I want to start out with is talking about investment thesis. Some of you might have seen some of my talks before, and I always start out with this content. So apologies if some of this is repetitive, but on a first principles levels, when I'm talking to somebody for the first time, these are the things that I will talk through. Okay, so investment thesis. What is this? You can think of an investment thesis as the boundaries or the focus areas where you decide to invest. Anything within this sphere, anything outside of it should be out of bounds, right? You shouldn't even be taking a look at it. The reason that you need to have an investment thesis is that the world is a big and noisy place, and it's so fast moving. And for all of us, there's only so much that we can know, right? If you're being honest with ourselves. So you really want to have some focus areas to give yourself an advantage in terms of what you invest in to give yourself the best possible chance of success. There are different forms of investment thesis, different levels of complexity. So I'm just going to start with the very, very basic. The most basic thesis and framework that I can come up with looks like this. Think about your sector and domain. Which verticals or industries do you invest in? Second, geography. Where do you deploy capital? Which continents or countries or even cities do you look at? And finally, what stage of companies do you invest in? Okay, so think about your investment thesis when you're starting out as a Venn diagram of these three things and mapping out where the centerpiece is. That's where you need to be investing. Okay, so you need to draw boundaries because you need to focus, and this is what's going to give you the best possible chance to be successful. Now, when you think about what drives these decisions for investors, there's a lot of human psychology at play here, right? A lot of things that make intuitive sense. And I know this because, simply put, I talk to a lot of investors and I know every single one of my investors, right? And I meet people all the time. The things that I've noticed look like this. When it comes to sector or domain, what drives investors' decisions is number one, familiarity. What do you know? It's very intuitive that whatever you're comfortable with, maybe through your work experience or your expertise or in education, that's going to be what you're going to gravitate to. The second is affinity. It could be something that you care about. For example, you have been through a really painful litigation, or you work with a lawyer and it costs you way too much money, and suddenly you think the world needs a lot more legal tech because it would make the world a better place. And that's absolutely fair. And finally, it could be a matter of interest. If you invested in cryptocurrency like Bitcoin really on and made a bunch of money, you're probably going to be a lot more interested in Web3 startups just because you've had your own success in that sector. Second, for geography, what we know is that early stage capital is very highly localized. In fact, the earlier the stage that you invest in, the more it's going to be local, right? For you as an individual angel, if you're probably going to be a pre-seed stage investor investing individually. And so you are going to be looking at your country, your state, or even your city level in your own backyard. I look at companies all around the world, and we look at a lot of companies in the US, and we know that we might be looking at a company in the West Coast, and the investors on the East Coast don't even know about it. It's just not on their radar, and vice versa. This is just a function of how early stage venture works. Now, the only other reason that you would consider investing in another geography where you don't live in is because there's some kind of connection. So for example, if you're part of the Indian diaspora, maybe you live in the US, you would have an interest in investing in India as well because it's where you grew up and you have a vested interest in seeing the country develop. And finally, stage. The stage that you invest in, the kind of companies, the stage of companies you invest in is largely a function of capital. If you are an angel investor writing a 4 or 5 figure check, maybe even up to mid 5 figures, you're going to be investing at pre-seed up to seed stage. In order to play at seed to Series A, realistically, you need to be able to write 30,000, maybe up to a six-figure check, maybe $500,000. And if you want to get into Series A's and B's, you need to be writing $250,000 up to millions of dollars of checks. So for most individual investors, or actually all investors, the check size that you write is going to dictate the stage that you play in. And I think this is like one argument of why investors should pay attention to other vehicles beyond just investing directly your own capital. Because investing through a syndicate or even a VC fund gives you a way to extend your stage access. Because you might say, hey, investing in pre-seed companies is actually really risky and it's above my risk tolerance. And I would rather invest at seed stage, Series A or Series B, but I can't do it because I write a small check. And so these other investment vehicles give you a way to choose your options. And very quickly, to add some color to this, let me talk about our investment thesis at Angel School. For the sector, we are mainly B2B technology and software investors. Why? The reason is that we believe that good technical founders should be able to build, ship product, and get traction with software, generally speaking. Not always the case, but generally. And it's a lot harder with sectors like hardware. And this becomes a way for us to de-risk because we don't invest in pre-product, pre-revenue companies. Even on the companies that I've invested in at pre-seed, they've all had a product in market and they've all had revenue. And longer term, software companies, it's much more scalable because everything is digital, it's online. And so as an investor, it's less long-run dilution, right? So it's cheaper to scale. And so the return should be better. Next, for geography, we're a little bit different, right? Because we built such a big network and it's global. We invest across US, Europe, and Asia. We split our 1,300 investors into 3 geographic clusters. We have our US cluster, which everybody's looking at the deal flow there because that's exactly where we started 3 or 4 years ago. And we launched our Europe and Asia teams about a year ago. And it's earlier stages, and we have about 300 or so investors following the deal flow in those clusters. And then finally, for the stage, we tend to play at seed stage up to Series A. We might do a pre-seed deal and write a relatively small check, which would be $100,000 or $200,000. But seed to Series A, we're probably writing $500,000 up to $1 million checks. And the whole strategy and goal for us is to keep growing the network so that we can keep scaling capital. And so maybe in a year, we'll be writing multi-million-dollar checks. We'll be playing up to Series B or C. I kind of want to open up the stages to approach this as a strategic decision, not as something that I play at because I'm restricted by capital. So that's how I think about it.